Yeah, I think it's right to be invested and to remain invested. And that's what we've done since basically the start of the year. But we've made our portfolios resilient exactly because it's very, very difficult to know when exactly this cyclical turn will happen. I think there's been a change of mindset since the middle of May, really, where clients have been asking us more about stocks that have been left behind, so a little bit more into the value, maybe a little bit more into the cyclicals, because the overweight on technology, the overweight on the US has been such a consensus trade that people have been trying to pick a little bit cheaper stocks, a little bit more optimistic about the cycle. That being said, we do think it will still be a slow and uneven and a fragile recovery. So we wouldn't go too much into the cyclicals or into the junk, if we want to call it that.
Willem, can you break it down by jurisdiction for us? Because I've been noting the very strong rally we saw in Europe last week, particularly concentrated around the core markets of Germany and France. 10% bounce, which means we're playing catch up. We're trying to keep up with those US gains. It's quite extraordinary. We don't always see that take place in Europe. How would you describe what is transpiring? And do you think that there is still increased appetite for European stocks?
So it's very much a catch-up situation indeed, and we are more positive, or we have a neutral on France and on Germany. We have that underweight on Italy and Spain. So it is hurting a little bit this week. But so far this year, what you've seen is indeed those cyclicals underperforming the defensives by around 20%. We've given up about 5% of that 20% underperformance. Value versus growth, about the same thing, 20% underperformance, 5-6%. Of narrowing of that differential. And Europe versus the US is the same thing. You've had sort of that widening of valuations. Now, that's obviously in part because of technology, but that basically narrowing a little bit. It's really sort of that search for stocks with a little bit more value to it that are less expensive, and people getting the courage to do that. Because of the oil price move, because of the European stimulus, because of the Fed stimulus as well. So still, obviously, Europe is a market with structurally lower growth. So therefore, I don't think the differential will completely narrow between the US and Europe, but you could see a few percentage points still further in terms of a catch-up situation.
Willem, I'm curious as to what fund managers are doing with the oil trade at this stage. I mean, clearly, from a hedge fund perspective, there's a lot of speculation that's been going on, and there's much more bullish trade. But more broadly, how willing are fund managers to put oil components into the portfolio, given that we're still not out of the woods in terms of that market volatility that was described by the Saudi energy minister over the weekend as this deal was inked with OPEC and its allies?
So what we can see in the data in terms of what the fund managers have been doing so far this year, again, they have been going out of the BRICS. So the likes of Brazil were really significantly hit by that, and therefore no surprise there that as we get that reversal, that Brazil is one of the ones that has been rallying the most. I think it's not supported by fundamentals, but it's a speculative move. Brazilian real for now, we think, overvalued after this rally. And also within the cyclicals versus defensives, the energy was one of those sectors where we saw a lot of outflows, and obviously people are now scrambling to cover that. So I think it is to a very large extent. So it's triggered by the European package, by the oil price move. But it is also significantly a position adjustment. If you believe, like us, that the economic recovery is still uncertain, fragile, and uneven, you want to, especially within that uneven recovery, you want to make sure that you own the companies that you want to own, those with the balance sheets, those with the margin power, and those with the almost oligopolistic position that you have in many sectors. That's the one that we want to stick with.